All right, let's take one more look at today's market. Again, a bit of a mixed picture. Dow holding on to gains. NASDAQ and S&P, though, moving to the downside. Let's talk about this with the eToro USA investment analyst, Callie Cox. And Callie, when you take a look at the mixed market reaction, I think one of the big reasons the Dow is still in the green today, some of that has to do with the GDP report that Dave was just talking about. What's your assessment, I guess, of the losses that we're seeing in tech today and then squaring that with the gains that we're seeing in the Dow?
Well, I think a lot of investors here are getting distracted by what's happening at Facebook. And of course, it's a hard day for Facebook investors. But across the market, we're really seeing a lot of strength in those more cyclical sectors. And that's a good sign. I mean, from where I sit, it looks like the market got a little too far on the side of expecting a recession or thinking that we were in a recession. And now it's walking that back because economic data recently just has been that strong.
And you say not always these day-to-day moves are based on logical reasoning, but rather based on what? And is this one of those days?
Yeah, well, that's true, too. I mean, when you're 20% below the highs and, the market mood just changes so quickly, you're going to get a lot of moves based on positioning. I mean, if you look at today, I think it's pretty clear that we're moving based on the GDP report and some headlines, and then, of course, Facebook. But there are some days that don't make sense, right? We saw with the September CPI report that the S&P fell 2% in a day and then rallied 5 or 6% to the close. And those are the positioning swings I'm talking about, just trying not to logic out every single move that the market makes here. It's important for investors to really stay grounded and keep control of their emotions in such a quickly changing environment.
Callie, looking ahead to the Fed meeting next week, obviously a lot of the investor focus is going to be on that. Real quick, and I guess before we get another rate hike, the 5 that we've already seen since March, have we seen the full effect of those rate hikes? And if not, how long until we do?
Well, I think that's the big question. And if you're a monetary policy wonk, kind of like I am, you know that policy works with a lag. And that's what the market is basically betting on right now. It's betting that the Fed is starting to realize that policy is working with a lag. And we are seeing some pretty significant parts of the economy crumble. I mean, in the GDP report this morning, one of the weakest components of the economy was housing, and that's a rate-sensitive sector. So we're looking at the Fed meeting. Investors are, stepping out and saying that they think the Fed will pivot, or not necessarily pivot, but maybe slow down on rate hikes soon because it's starting to see those effects bleed into the economy. And ultimately, the Fed doesn't want to cause a recession if it doesn't need to do so, because its dual mandate is inflation and it's the job market. It knows it can lean on the job market a little bit here because the job market is still decent, but are we seeing growth shift back to the point where it could significantly bring down inflation? They're not so sure, and they don't want to push it.
You mentioned housing, and a lot of people feel that way, but when you look at the numbers, still up double digits on a year-to-year basis, although the price increases are beginning to cool. What other evidence is there that the Fed's job is succeeding?
Well, I feel like success is an open question here because there are some signs. I mean, the surging dollar is one of those signs that the Fed's rate hikes are bleeding into the markets. But success there has looked like an economic crisis over in Europe and an energy crisis that they can't quite handle. So the Fed has to take that into account as well because the global economy is more intertwined than ever. I mean, we've also seen a lot of the effects of Fed rate hikes in the bond market. We've seen the yield curve pretty much invert across the all maturities, short and long term. So, the Fed looks at that too. They see that things are getting a little wacky out there, and they understand that there are secondary effects here. And we are seeing demand slow. We're not quite in a recession yet, but we are seeing it slow down. And the Fed can only assume that's going to continue.
Callie, let's take a look at the VIX because it's something you specifically pointed out in your notes. And we're seeing the VIX pull back once again today, right around 27. There's this huge debate out there about whether or not we need to see a massive spike in the VIX, given what we've seen in the past 2 bear markets to really signal that we are out of the woods just yet. Do you think there's some sort of misunderstanding when it comes to the VIX, or how are you reading the recent action that we've been seeing there?
Yeah, so it's funny that this is such a debate because I really think, and this is the most dangerous phrase in finance, I say that knowing this, but I really think this time is different here. The VIX, what we're seeing is this kind of slow burn bear market where investors have been nervous all year and they've been hedged up all year. We've seen that with data, coming out of AAII. We've seen that with cash levels. And, when investors are really hedged up, you don't see those big moves in the VIX because we're expecting it. I mean, another thing that I'm thinking about too is that the VIX is a measure of 1 month options implied volatility. But we have so many tools at our disposal, and we're seeing more and more signs that investors are becoming more precise in their hedging. They're looking at events like Fed days and job reports, and they're using daily and weekly options to hedge around those. You're not going to see that caught in the VIX's daily moves. So as an options nerd, I think it's a really interesting argument there. But for investors too, I think it's a reminder not to lean too far on classic market indicators, to remember the context of what we're watching the market in.
So then, nerd, and I'm using your words, not mine. I do not think you're a nerd. What do you see in the VIX? What is it telling you?
I mean, I'll take it. I'm a nerd. I'll take it.
I like you.
I mean, I'll embrace it. There's clearly a lot of fear out there. The VIX is around 30, and there's a pile of metrics out there showing us that investors are fearful. But it's a healthy fear, right? It's a fear that they've held on to for most of the year, and it's a fear that's kept stocks resilient where they are right now. There's a reason why we've seen so many crazy relief rallies lately. It's because we have a lot of investors on the sidelines, and they're watching the momentum and they're watching the headlines to see when the best time it is to step in. So, I think that the VIX shows fear, even though it's not up at the 70 or 80 levels that we saw during the financial crisis, during COVID. But at the same time, you really just have to read it differently these days.
So, Callie, given all the uncertainty out there, we were talking about the Fed, there is so much just unknown, the strong dollar, a number of headwinds. How should investors be allocated now?
We have stood by really liking a barbell strategy this year, holding on to risk because we don't know when the market turns, quality risk that is, but also staying a little bit defensive. I'm going to be honest here, if we see economic data stay strong, and if we see the Fed, possibly look towards slowing rate hikes, I think that there could be some value in more value-oriented cyclical sectors here, like financials and industrials. But I haven't quite seen a lot there. So right now we're really liking the barbell of being defensive because we're not quite sure where the economy is, and holding on to that risk just in case the bull market starts before we think it will. Because stocks lead the economy, let's be honest.